The S&P 500 is at all-time highs, and if you've been holding a diversified mix of big tech for the last 6 months, you might actually be underperforming the index. That's not an accident. Something is shifting. Money is moving, and most retail investors haven't noticed yet. Today, I'm going to show you exactly where it's going. Okay, from 2023 to 2025, the playbook was simple. Buy anything with AI in the name. Invyra, Microsoft, Meta. It worked beautifully. 2026 is different. The index is still up, but underneath it, there's a significant rotation happening. Industrials, energy, consumer defensives, utilities. These sectors are leading, and the investors who repositioned early are quietly outperforming. So the real question is, are you positioned for what's actually happening or for what worked 3 years ago? Here's the mistake I see a lot of investors making right now. AI is booming, buy tech. But that's 2023 thinking. In 2026, AI isn't a sector anymore. It's everything. It's a theme, spilling over into energy, industrials, and utilities. The investors only looking at NASDAQ are watching the tip of the iceberg and missing what's building underneath. Let's start with the sector that surprised almost everyone: energy. Two completely separate catalysts reinforcing each other. The first is obvious: oil prices and Middle East geopolitical tension. But here's the more interesting one. AI data centers need enormous amounts of electricity. A lot of that comes from natural gas infrastructure. Williams Companies is a perfect example. Most see it as a boring pipeline company, but Williams Companies is actively repositioning as energy infrastructure for AI data centers. I ran this company through Invyra. Fair value, $45.23. Current price, $77.69. That's roughly a 71.8% higher. Risk to flag. If Middle East tensions cool or gas demand slows, this thesis weakens fast. Not a set-and-forget position. Industrials, the most unglamorous sector in the market. Charles Schwab has it rated overweight. Morningstar identifies it as one of the major contributors to index performance this year. The reason is simple. AI infrastructure requires physical things: equipment, turbines, transformers, grid upgrades, defense systems. All of that flows through industrials. GE Vernova is the company I keep coming back to. Most people still think of GE as the old conglomerate. GEV is a completely different business: clean energy and grid equipment. It just raised its annual revenue forecast because of data center demand. Reuters called it an overlooked AI investment, and I agree. Invyra puts GE the fair value at $585.30. Current price, $1,012.25. And here's what the MOAT score and ROIC look like. A real structural growth driver, AI power infrastructure, with a business that has the physical assets, the order book, and the margins to back it up. If you want to dig deeper, ask Invyra's AI assistant about GE Vernova's competitive positioning or how it compares to peers. It answers in plain language from real data. Utilities, the most boring sector on the planet. But Fidelity's 2026 outlook describes it as entering a once-in-a-generation growth cycle. AI data centers are consuming electricity at a scale the grid wasn't built for. Utilities are building the capacity to meet that demand right now. The structural story is genuinely strong. But here's the risk I want to flag, honestly. Utilities are interest rate sensitive. In plain English, if bond yields stay high, people may prefer a safe 5% bond over a utility dividend, and that can cap the upside. Morningstar specifically cautioned that some utility names may have run too far, too fast. So I'd be selective here, not sector-wide. Now let's talk about the sector everyone is already in, but I want to reframe how you're thinking about it. Big tech as a whole? I think the easy money is done. We're in what some analysts are calling AI exhaustion, not because AI is over, but because the market has already priced in a lot of the optimism. But within tech, there's still a specific corner that major banks are overweighting: semiconductors and AI chip infrastructure. The question isn't whether to own semiconductors. The question is, at what price? Invyra's models put Nvidia's fair value at around $193.34. Current price, $222.32. That's roughly a 15% premium. It's not about being bullish or bearish on AI. It's about knowing where within the AI trade you're getting value and where you're just paying for the story. Nvidia is a world-class business. But at current prices, you need everything to go right. For WMB and GEV, the bar is much lower. That's what makes them more interesting. Quick transparency. I'm holding Nvidia. I don't own WMB or GEV yet, but both are on my watch list. I used Invyra's AI assistant to pressure test my assumptions. You can ask it anything about these stocks, and it answers from real data. The models help me think. They don't make the decision for me. Okay, so in 2023 and 2024, the AI trade was simple: buy the software and chips. But in 2026, AI has grown up. It needs physical infrastructure, power lines, turbines, pipelines, grid equipment. The companies building this infrastructure are, in many cases, trading at much more reasonable valuations than the AI stocks everyone already knows. Energy, industrials, selective utilities, a very specific corner of semiconductors. Those are the four areas I'll be watching most closely in the rest of 2026. Not because the macro is perfect, it's not, but because the businesses are real. The demand is real, and in some cases, the prices are still genuinely reasonable. And in this market, reasonable is rare. If you want to run any of these stocks through the same Invyra model, Tesla, Apple, Nvidia, or anything else, it is free for now. So, which sector are you most interested in for the rest of 2026? Let me know and discuss.